BTC investor sentiment turns increasingly bullish. After this week's quick rebound from a sharp price correction, Bitcoin experienced a 5% increase after testing the $25,000 support level on September 11th. However, this breakout rally doesn't necessarily indicate a victory for bulls. To put today's price action in perspective, Bitcoin has witnessed a 15% decline since July. In contrast, the S&P 500 index and gold have maintained relatively stable positions during this period. This underperformance demonstrates that Bitcoin has struggled to gain momentum despite significant catalysts such as MicroStrategy's plan to acquire an additional $750 million worth of BTC and the multiple requests for Bitcoin spot exchange-traded funds from trillion-dollar asset management firms. Still, according to Bitcoin derivatives, bulls are confident that $25,000 marked a bottom and open room for further price gains. Some argue that Bitcoin's primary drivers for 2024 are still in play, specifically the prospects of a spot ETF and the reduction in new supply following the April 2024 halving. Additionally, some of the cryptocurrency market's immediate risks have diminished following the United States Securities and Exchange Commission experiencing partial losses in 3 separate cases involving Grayscale, Residence, and the decentralized exchange Uniswap. On the other hand, bears have their own set of advantages, including the ongoing legal cases against leading exchanges like Binance and Coinbase. Moreover, there is the troubled financial situation of Digital Currency Group after one of its subsidiaries declared bankruptcy in January 2023. The group is burdened with debts exceeding $3 million, potentially leading to the sale. Funds managed by Grayscale, including the Grayscale Bitcoin Trust. And I look at derivatives metrics as will better explain how professional traders are positioned in the current market conditions. So Bitcoin monthly futures typically trade at a slight premium to spot markets, indicating that sellers are asking for more money to delay settlement. As a result, BTC futures contracts should typically trade at a 5 to 10% annualized premium, a situation known as contango, which is not unique to crypto markets. It's worth noting that the demand for leveraged BTC long and short positions through futures contracts did not have a significant impact on the drop below the $25,000 mark on September 11th, however. The BTC futures premium continues to hover below the 5% neutral threshold. This metric remains in the neutral to bearish range, indicating a lack of demand for leveraged long positions. To gauge market sentiment further, it's helpful to look at the options markets, as the 25% delta skew can assess whether the retest of the $25,000 level has made investors more optimistic and short. If traders expect a drop in Bitcoin's price, the skew metric will rise above 7%, while periods of excitement typically have a negative 7% skew. This situation underwent a notable shift on September 11th, as the 25% delta skew metric, which previously indicated a 9% premium on protected put options, suggesting investors were expecting a correction, has now leveled off at 0. This indicates balanced pricing between call and put options, implying equal odds for both bullish and bearish price movements. Given the uncertainty on the macroeconomic front, particularly with the upcoming release of the Consumer Price Index report on September 13th and retail sales data on September 14th, it's likely that crypto traders will be cautious and prefer a return to the mean. In this context, the mean represents the predominant trading range of $25,500 to $26,200 observed over the past couple of weeks. However, from a bullish perspective, the fact that derivatives markets held up during the dip below $25,000 is a promising sign. In other words, if bears had significant conviction promising, one would expect a stronger appetite for put options and a negative BTC futures premium known as backwardation. Naturally, ultimately, both bulls and bears have significant triggers that could influence the price of Bitcoin, but predicting the timing of events such as court decisions and ETF rulings is a challenge, and this dual uncertainty likely explains why derivatives metrics have remained resilient, as both sides exercise caution to avoid excessive exposure.